joining us this morning. Will run us through some of the activity we're seeing on the currency side of things right now. The unit still hovering around the 150 Naira mark.
Well, Alicia, the currency is still hovering around the 150 Naira to $1 mark, and this has been like that for over 3 to 4 weeks now. We've seen that the demand actually meets the supply in the market. Central bank has been able to prove that it can meet the dollar demand from the market, and this what has helped them really is the oil prices at its current level. And to the extent that the oil price continue to remain at its current level, it will give them more confidence to be able to support the Naira. And even on the interbank front, the activities have been very low. There's been no much volatility, so market players are just trading along the line of the 150 mark at the moment.
Being noted, though, is that yields across all fixed income assets have been falling since the central bank last week lowered its standard deposit facility rate by 100 basis points to 1%, prompting many foreign investors to pull out of the funds. To what extent are people divesting from fixed income assets and taking their funds out through the interbank market?
Well, Alicia, I must say, if you look at the distribution of the fixed income holders, the foreign investors do not really constitute a significant part of the holdings at the moment. During the crisis, most of them exited the market, but since the drop in the corridor of the MPC rate by 1%, with a standing deposit rate at the central bank now at 1%, most of the interbank players have decided to start taking profit. Rates immediately drop, and people thought it only made sense for them to start taking profit in the market. And with that, if you look at the yields on the bond side now, it's beginning to inch up gradually. Even some of the pension funds, some of the non-bank financial institutions that are holding this bond are beginning to see the need to take profit and have some capital gains before the yields go up again. On the longer end of the curve, you say that yields are beginning to inch up gradually, and that's because our market players are taking profit.
In the meantime, First Bank's Eurobond surged to an all-time high yesterday of $100.75. Renaissance Capital attributing the improvement in perception to international risk. What have you made of that movement where we've seen this price now exceeding the $100 threshold?
In our opinion, I think it only makes sense for people to start going into the First Bank bond. I mean, that's why you're seeing a lot of demand for the bond. At some point, it was trading at lows of 65. Right now, as at trading yesterday, we're already seeing it at 101. If you recall, this is a callable bond, and the yield to call right now is still at 9.1, which only makes sense. And speculations all over the market is that they are going to call this bond on 30th March 2012. So when you look at it and the asset classes available for dollars, I think a 9.1 yield is still something good, especially if it is going to be called in March 2012, as people are saying. But the full tenor of the instrument is a 10-year instrument. I mean, right now it's left with 7 years, which is 2017. And if you can, speculations arrive that it's going to be called 2012. If that is true, then a 9.1 instrument for, a dollar-denominated bond, I think that is a very good yield, and that's why people are still going into it. If you ask me for my outlook, I would say you still see more rush into the bond, and the yields will drop further.